Welcome to this explainer. I am absolutely thrilled you're here because today we're going to put on our detective hats and step into the shoes of a financial investigator. We are diving deep into the fascinating Q3 2026 financial filing of Northern Technologies International Corporation, or NTIC for short. Now, on the surface, corporate filings can look like just this endless, dry wall of numbers, but when you know how to structure the information, well, those numbers tell an incredibly gripping story. So let's get started. To really anchor our investigation, we're going to be looking at the actual Form 10-Q. This was filed with the Securities and Exchange Commission for the quarter ending May 31, 2026. Every single clue we're going to decode today comes directly from these pages. We aren't speculating here. We are literally just following the paper trail they've laid right out for us. Okay, let's dive into this by presenting the core paradox of our story. Imagine you're running a business, right? And your sales hit a record high for the quarter. You'd probably expect to be popping champagne or, at least grabbing a nice sparkling cider. But for NTC, a massive jump in sales somehow resulted in a swing to a net loss. So how in the world does that happen? To solve this, here is our roadmap for today. First, we'll cover the revenue paradox. Second, the joint venture lifeline. Third, the debt dilemma. And finally, pausing the payout. Section 1, the revenue paradox. If you're an investor and you're just glancing at the top line, things look fantastic. Back in Q3 of 2025, NTIT had net sales of $21.5 million. Fast forward to Q3 2026, and they're driving over $24.2 million in quarterly sales. That is some seriously impressive top-line growth. They're moving product, and business just appears to be booming. Now, what's really interesting about this slide is the jarring reality hiding on the exact same income statement. Despite generating over $24 million in sales, the net loss attributable to NTIC for this quarter was $263,291. They didn't just make less profit, they actually lost money. Contrast that to the exact same quarter the previous year, where they pulled a positive net income of over $121,000. So where did all that record sales cash actually go? Well, the filing clearly points the finger at surging costs. First off, their cost of goods sold jumped from $13.2 million up to over $16 million. But the real heavy hitter? That was their total operating expenses, which climbed to over $10.1 million. Between selling expenses, general administrative costs, and research, these rising expenses absolutely devoured all of those record sales gains. Section 2, the joint venture lifeline. With their domestic operations practically burning through cash, we need to shift our investigation overseas to understand what is actually keeping this company afloat right now. NTIC's hidden superpower lies internationally. They have this massive network of joint ventures. Just look at Xcore in Germany. It's an absolute powerhouse, pulling in over $1.4 million in net income. Then you've got Akabal in France, bringing in over $686,000, plus highly profitable ventures in Finland and Sweden. Why does this matter so much? Because NTEC gets a cut of those profits. Their share of equity and income from these joint ventures for the quarter was a massive $1,517,174. This is acting as a giant financial cushion. Seriously, if they didn't have this $1.5 million injection from their overseas partners, that $263,000 net loss we talked about a minute ago, it would have been catastrophically worse. Section 3, the debt dilemma. The thing is, relying on your partners overseas to bail out your operational losses isn't exactly a permanent fix, especially when you have hidden dangers lurking right on your balance sheet. To finance their operations, NTIC relies on a line of credit with JPMorgan Chase. Back in August of 2025, they had about $9.3 million drawn on this line. But by May of 2026, that balance steadily crept up to nearly $11.8 million. As their operational costs grew, the reliance on borrowed cash grew right alongside it. Now, banks don't just hand out millions of dollars without setting some strict ground rules, which are known as covenants. One of the most important covenants in NTTIC's credit agreement is the fixed charge coverage ratio. Let's break this financial jargon down into plain English. This is essentially a corporate credit score. It measures a company's ability to generate enough income to easily cover its fixed charges, like its required debt payments. So the crucial point here is how NTIC actually scored. According to the SEC filing, JP Morgan Chase requires NTIC to maintain a ratio of at least 1.25 to 1.00, meaning they need to bring in 25% more than their fixed obligations. But because of those operational losses we discussed, NTIC's actual score plummeted to just 0.68 to 1.00. They failed their bank's financial test by a very significant margin.
When you fail a bank covenant, you're technically in default. To avoid having the bank immediately demand all that $11.7 million back right then and there, NTIC had to go hat in hand to JP Morgan. On July 7, 2026, they secured a formal waiver for this covenant breach. Now, this buys them some much-needed time. But make no mistake, requiring a waiver from your bank is a giant flashing warning sign of financial distress.
Section 4. Pausing the payout. This financial distress isn't just some abstract accounting issue. It has a very direct, real-world impact on the people who own the stock. On April 24, 2026, management was forced to make a really tough call. They announced a suspension of its quarterly cash dividend on its common stock to focus on the reduction of its outstanding debt. The debt dilemma totally forced management's hand. I mean, when you're asking your bank for a waiver because you can't cover your fixed charges, you certainly cannot justify sending out cash checks to your shareholders. When we step back and look at the final picture, the domino effect is crystal clear. The operational losses from rising expenses led to more borrowing. The higher debt and low income triggered a failure of the bank's fixed charge coverage ratio. And because the credit agreement actively restricts dividend payments during a default, the payout was paused entirely. For Q3 2026, shareholders got $0 in dividends, compared to a penny per share in that same quarter the previous year. Which leaves us with this final, really provocative question. We've decoded the clues from this Form 10Q. We know they're plugging the holes with joint venture profits and saving cash by cutting the dividend. But as they approach their annual report, will these emergency measures be enough to satisfy the bank, conquer those rising operating expenses, and finally turn NTIC's ship around? We are definitely going to have to wait for the next filing to find out. Thank you so much for joining me on this explainer, and keep learning.